Dean Orrico, manager of Middlefield Canadian Income. Dean, are you there?
Yes. How are you, Matthew?
Very well. Thanks for joining us. So for those who don't know, Dean is president and CEO of Middlefield Group, and he's lead manager of Middlefield's real estate and London Stock Exchange listed funds, which includes Middlefield Canadian Income, which we are going to discuss today. Dean, do you just want to give us sort of a few minutes, just talk through the fund, tell us what you do? Yeah, just give us the sort of big elevator pitch, if you like.
Sure. Thank you for having me. And at a high level, we launched this fund in 2006 on the London Stock Exchange, and it's really just a continuation of what we do here in Canada. We're headquartered in Toronto. We've had a London office and have been managing money for UK-based investors really since the early 1990s. Given our expertise in equity income, we wanted to bring that expertise and our strategy to UK investors. And that's what we did in 2006 when we launched this fund. And as you'll see through the slides that you'll be on the screen in a few minutes, this is really quite a unique strategy. We are in the peer group of North American funds, investment trusts, but we are uniquely Canadian. They call themselves North American, but by and large, they are all really focused on the US market. And we really believe that there is a very unique value proposition right now in Canada, which is represented in our fund.
Excellent. Okay, do you want to run through some of the slides then?
I'd be happy to, yeah. So starting at the macro level, Matthew, I think, again, this is really creating quite an attractive backdrop for Middlefield Canadian. When you look back through the last 20 years or so, this period of 2010 to 2021 was really one that was highlighted by zero interest rates coming out of the GFC, and that really made anything very growth oriented and hence technology focused the highlight of the market. And that's not what we do at Middlefield. We're generally looking at relatively dull, boring businesses that generate high levels of cash flow and pay out high levels of income. And we think what was basically a headwind during that 10-year period changed in 2021 as you started to see higher levels of inflation and central bankers basically respond with higher interest rates. And we've seen, as you have been discussing, much higher interest rates in the last 18 months than we had for the 10-year period prior. And we think that's really creating an environment right now where you just can't rely on growth stocks because they're long duration assets now being discounted at a higher interest rate. We think rates and inflation will remain higher than what you've seen during that prior 10-year period. Maybe not as high as they are today, but we think the days of zero interest rates and relatively non-existent inflation are in the rearview mirror. So as a result, we think from a macro perspective, that's really setting us up for a much more attractive environment for what we do at Middlefield and what we're invested in Middlefield Canadian. And it's somewhat analogous to this super cycle in commodities that we saw during that period of kind of 2000 to 2010, when China came into the WTO. It basically had this insatiable appetite for commodities, a lot of the things that we produce here in Canada. And I think what's also reminiscent of that period is Russia's invasion of Ukraine on February 24th of last year, which again is highlighting that there is a real necessity and demand for secure sources of energy, basically helping us transition to a more environmentally friendly energy environment, but highlighting the need for security. So really that's where we are today. And as you can see at the bottom of this particular slide, we are also now seeing very attractive valuations in the Canadian market because even if you exclude the technology sector, Canada's still trading at a 3-turn discount to the S&P 500. So again, with this macro environment being much more conducive and valuations being very attractive, we think this is turning out to be a very good setup.
That
The next
chart
slide.
is sort of particularly interesting. Why do you think that Canada is sort of trading at a bit of a discount there?
Well, I think there's a few reasons. One, even this year, Matthew, it's really been an environment highlighted by technology.
Mm-hmm.
Really, when you look at what's happened with the S&P 500 up 17 or 18%, the Canadian market's only up 5%. And I
Yeah.
think there continues to be concern about hydrocarbon energy. There continues to be concern about financials. Again, about a third of our market in Canada is financials. We arguably have one of the strongest financials or banking sectors in the world.
Mm-hmm.
But we also know that in this era of higher interest rates, there's concerns about mortgage repayments. Capital markets activity has been basically non-existent. Wealth management industry continues to suffer under higher levels of compliance and thinner margins. So again, our financials haven't really led the way like they have in previous eras. So I think all of these things are conspiring to make the Canadian market more challenged and hence undervalued, especially when you compare it to the US market.
Yeah. Okay. You have a look at the next slide? Or
Sure, that'd be great.
okay.
So again, given this view that we think inflation is going to remain higher than what you've seen historically, again, not the 8 or 9% range, but clearly not the 0 to 1% range that we had for an extended period prior to 2021. We think Canada represents a great way to hedge yourself against these higher levels of inflation. We describe this on this particular slide. We are a net exporter of oil, natural gas, and electricity. Again, that provides this better positioning relative to higher commodity prices. And when you just look at our petrol costs versus petrol costs in the UK, we're some 35% less than what you see in the UK. Significant lower cost of electricity in Canada, again, what you'd see in the UK. So Canada does have some real relative advantages relative to the UK and or Europe. We're also a major producer of key materials, potash, one of the major sources of fertilizer. Again, we're the largest producer globally. And I would also say that with respect to inflation generally, we continue to have relatively lower levels of inflation, again, by virtue of having an abundance of resources, which we're not having to import and pay higher prices for. I think that's keeping inflation down. The other factor is that on a population of 40 million people, last year we brought in about 500,000 permanent residents and another 500,000 people in the form of temporary foreign workers and international students, because we have some world-class universities here in Canada. So I think that addition to our labor force is also helping to keep labor costs more in check, and as a result, again, keeping inflation down as well.
Okay, that makes a lot of sense. All right.
Want to move to the next slide?
Yep.
So let's look at the fund in particular. Again, in our view, this is unique, and as a result, we think it does represent a good diversifier for UK investors. Again, given our focus at Middlefield, we are squarely focused on equity income, which basically means that we're focused on companies that can pay high and growing levels of dividends, and that's what we're doing in Middlefield Canadian. We pay out a dividend of 5.2p per year, which currently represents a yield of about 5%. We increased that distribution early this year. We are running a covered dividend so far in 2023, and the board's view would be to continue to increase the dividend over time, assuming that the fund is able to sustain a higher level of dividend. So clearly that's the case. We're high conviction managers, so we buy companies that we know well. We meet these management teams on a regular basis, so as a result, there's relatively low turnover, and we're trading at a discount to NAV currently of about 11 or 12%. So we think that represents excellent value. On the right-hand side of this particular chart, you can see our performance, and in particular, long-term performance has been very competitive in excess of our benchmark, and it's this shorter run performance really on the back of higher interest rates, which has caused a headwind against equities generally, and in particular, more interest-sensitive equities like real estate or like our utilities or even financials. So as a result, there's been some more challenging performance in the shorter term, and we think that is really on the verge of starting to turn around now. And the reason we think that is that what you've seen here is this rapid rise in interest rates, really beginning from the spring of 2022 up until recently. The Bank of Canada met last week, and it chose to not increase rates. So the signals are that as long as inflation remains in check, and we think it will, that they're basically going to be on hold. I think you're likely going to see the same decision out of the FOMC next week when they meet, that they'll basically remain on hold as well. The way I like to look at it is that we're at least in the 8th inning of this interest rate hiking cycle, and we may very well be at the end. And any way you look at it, it's basically over. And I think that's now going to provide investors with more clarity on interest rate hikes and that they're basically over. So I think that causes them to feel better about some of the sectors that we're invested in. And that's why I think you're going to start to see some performance turn around.
Cool.
Next slide.
Yep.
So here's how the portfolio is positioned. And again, it's really looking to fully exploit some of these macro and more high-level issues I've been talking about with respect to increases in population, with respect to the interest rate cycle being over, with respect to looking for security and energy. So we have energy and pipeline exposure in aggregate at about 37%, and that's up from the low 30s early this year. As you've seen, we now have Brent prices well through $90 a barrel. WTI, which is basically the oil price that we receive here in North America, is now at $90 a barrel. Natural gas prices are now approaching $3 an M, and we're completing LNG export facilities, which would see us receive closer to $10 or $12 an M in natural gas prices.
Right.
So there's some upside coming from that over time. So we're very constructive on the outlook for energy right now. And again, it goes back to this issue of the world basically changing on February 24th of last year when Russia went into Ukraine, and people now better appreciating the need for hydrocarbons as we bridge ourselves to a more renewable future in energy over the next few decades.
Yeah.
Real estate would be one of our major outliers when you look at the benchmark weighting. Matthew, it's basically closer to about 5 or 6%, and we're at about 23%. And we've just heard you describe some of the challenges in the real estate market in the UK. And similarly in Canada, we've got real estate trading at significant discounts to NAV. But in my 25 plus years in managing publicly listed REIT portfolios, I've rarely been as excited as I am today about the fundamentals in the sector. I've basically met with virtually all of our REIT management teams in the past 2 weeks. And I can say that outside of the office property sector, the outlook for Canadian real estate in particular is very, very attractive, as good as I've seen in the last decade. And as I mentioned as well, financials, which represent in our benchmark about 32% of the market, we're closer at 21%. The reason why we're underweight there is because we think there's still going to be some lagged effect in terms of where capital markets activity is going to be. The wealth management business, we think, is going to take some time here to turn around. So we still have a healthy weighting. We still have very high conviction in the quality of our Canadian banking system. But as a result, we're underweight here, and you may see that nudge higher as we go into 2024.
Okay, we do actually have a couple of questions that may be worth addressing here. Because I think people are obviously aware of the sort of sector allocation you've got there. One of them just says real estate companies comprise about a quarter of MCT's holdings. You see, obviously, they're a significant overweight. Could you just talk about your rationale around this? Obviously, we've covered the valuation argument, and we've also, obviously, you've been speaking to them and you're sort of feeling very confident on their outlook. But I think this is is this sort of long-term structural overweight, if I remember rightly? Perhaps we could just talk a bit more to that.
Yeah, happy to.
Um,
I think we might have it on the next slide here as well.
all
When we
right,
talk
okay, let's
about
quickly look at
real
that then.
estate. Here we go. So when you look at the sector as a whole, it's trading at about a 25% discount to its NAV.
Mm.
So the real question there is the NAV a true NAV? And if you assume that it is, and I'll get into the detail there in a second, then why is it trading at such a discount and what's the outlook? So firstly, we've looked at these companies very carefully. We own about 8 or 10 of them in the portfolio. And I've known these companies and these management teams for now over 2 decades, for the most part. And we think they've done a very good job in terms of increasing the capitalization rate, which is used to determine the value of their assets. And they've been quite conservative in terms of how they manage the valuation of their assets. So in addition to that, there have been some third-party transactions in the market that, again, are validating the value of their assets. So we do think the NAVs are actually properly reflecting the current environment and including the current interest rate environment. First point. Second point is, why are they trading at such deep discounts? Now, this 26% discount you see on the screen here is actually skewed to the downside or skewed higher by virtue of the office sector. We've got a couple of office REITs in Canada that are trading at 40 and 50% discounts to NAV. And it's important to highlight, we don't own any office REITs in the Canadian portfolio. Right. Yes, they're very cheap, but we still think there are some real headwinds and issues, including negative sentiment that needs to be overcome in that sector. So our portfolio, which comprises industrial property, which comprises apartment REITs, and also retail brick and mortar REITs, this is where we really see the fundamentals extremely strong. So on industrial, Matt, again, the Greater Toronto area is the hottest industrial market in North America. It's the second largest in North America, second only to Chicago. We've got vacancy in this market at less than 1.5%. We've got rental rates and releasing spreads in particular in 2023 that are 20 to 30% higher than the leases that were in place. So the increases in cash flow continue to be very good. On the apartment REITs, again, when you think about the types of population increases we're seeing in this country, because we've got a shortage of labor and we've got a points-based immigration system that's trying to bring in new Canadians who can address some of these shortages in labor by ranking them based on their skill set. We think that really drives demand for housing. And currently, we have the lowest level of housing per capita in the G7. So average rent for apartment REITs today is about $1,800 per month. The market rent is closer to about $2,700 or $2,800 per month. So when a tenant vacates an apartment and a new tenant comes in, that's when, in a province like Ontario, they can actually increase the rent to market rate. So that represents about a 30% increase, 40% increase in some cases for those apartment suites. In a province like Alberta, where you've got some of our apartment REITs operating, there is no requirement to wait for a tenant to leave before you increase the rent. You can mark it up to market rent each and every year. So we think that outlook remains attractive. And then we have a shortage of supply in apartments in Canada. And just yesterday, our federal government announced that they were waiving what we call the HST, which is an excise tax, which is total of 5% federally and 8% provincially on any new purpose-built rental construction. So that creating another incentive to create more supply, and some of our REITs are very active in that, which we think will generate additional cash flow for them as well. So we think that's positive. And then the last area would be the brick and mortar retail. And again, these are not shopping malls, which have been the most challenged part of the real estate market. They are Walmart or grocery anchored open air centers. We haven't seen much new construction, so the supply is constrained. And as I talk to each one of the CEOs of our apartment REITs, and there's an interview with one that's on our website with one of our largest holdings, which is Choice REIT. I had a meeting with them earlier in the summer. They are the landlord to Loblaws, which is our largest grocer in Canada. They're saying virtually all of their major tenants are looking for new space.
Right. Okay.
And hence rents are going higher. So for those fundamental reasons, this is a very attractive time to be invested in the sector. And when you look at the macroeconomic picture with rates now basically plateauing and likely going lower later in 2024, we think we finally are going to see a point where investors can feel more comfortable about coming back into this sector.